Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Here's the take on the economy. Nathan Sheets of Citi writing the following. We see global growth this year softening to 2.1%, down from under 3% last year. Given the trajectory of recent developments, the risks to our forecasts are skewed to the downside. Nathan joins us now for more. Nathan, good morning.
Good to be here.
How much has changed for you and the team in the last 4 months?
Oh, this is a completely different world. One, as you read, our view is that global growth this year and next year are both going to be much weaker. But even beyond that, it's deeply structural. And I think we felt that this week during the bank fund meetings. The U.S. has been the center of the system for decades. And now the U.S. is standing up and rejecting in very fundamental ways key features of the system. And I think the rest of the world is just kind of looking around and saying, what's next?
There are the near-term effects and there are the longer-term ramifications. In the near term, all of the finance ministers and central bankers are saying we need the dollar to be the reserve currency. How much do you expect that, though, to change longer term? And are they questioning that in private conversations with you?
I think that's one of the leading questions that I'm hearing is, what about the dollar's role over the medium to long run as reserve currency? But even if we extrapolate out 5 to 10 years, it's still not clear that there are really any real challengers for the dollar in that role. And I think most say, well, we're kind of stuck with the dollar. But then the question comes, at what price? And I think that question of risk premium on U.S. assets is one that markets are struggling with as we speak.
Which goes to the question of weakness. And if there is some sort of downturn in the United States, what is the fiscal impulse and the ability for the United States to borrow into weakness at a time where we have near record deficits as a percentage of GDP and you have this structural shift going on?
If we have a downturn, and that is a very reasonable, plausible scenario, many people have that as their baseline forecast. If we have a downturn in the United States, the implications for the U.S. fiscal deficit are grim. We could be, again, easily knocking on the door of 10% fiscal deficits. And in that environment, do I think the Treasury can issue? I do. But again, at what price? What do those yields look like? What are the risk premiums? And I think that's the question we're going to be struggling with in the years ahead, is where is this risk premium going?
The president this morning speaking to Time magazine saying that he didn't get the yips. The bond market got the yips, but it wasn't the reason why he came out with that pause, even though everyone is saying that was the Trump put in action. Do you think that it is this bond market that is putting pressure up against this administration to come out and tweak and change policy?
I think the bond market has been front and center in this. I think it's the financial markets more broadly. But I also think it's the discussion with CEOs and what he's hearing. And I think it's political realities. I think there was a lot of pushback to this tariff policy, and I think the upshot of that is that we've officially now moved, it seems, from the phase of announcing tariffs to the phase of negotiating what these tariffs are ultimately going to look like. And maybe that's progress.
When it comes to China, the 145% is unsustainable. Everyone continues to say that. But even if we go to 60%, which was what the president talked about on the campaign trail, is that still, in essence, a trade embargo between Washington and Beijing?
145% tariff is prohibitive. And I argued during the election that a 60% tariff would be prohibitive. It would destroy many supply chains and mean a lot of shelves at various stores were empty. So absolutely, 60%, we're going to still see sharp declines in imports from China with negative ramifications throughout the economy.
We've seen some pull forward, and certainly we've seen that in retail sales, and we're probably going to see that in inventories too. I want to understand from your perspective how much time we actually have here. It takes somewhere between 20 to 40 days to get a ship from China to the United States. The tariffs went on April 2nd. How close are we?
This is another issue that we're debating in real time. My view is that the second quarter is likely to be okay. that we've seen the soft data fall off, but the hard data are lagging, and they're going to continue to lag as people continue to front load inventories and probably certain types of consumption. But the third and fourth quarter could be pretty ugly. I think that's the heart of darkness.
How convinced are you and the team that they'd respond quickly, the Federal Reserve being they, to any sign of weakness?
The Fed is in a very tough place here, where the bond market is equally focused, if not more focused, on what's going to happen with inflation. And so what the Fed has got to do is make sure that inflation expectations are well anchored. And once that's achieved, then they can pivot to rate cuts. And I do expect that by the end of the year, we'll be seeing rate cuts, but it could take us a few months, and it may not be at the first sign of weakness.
And that could mean a lot of pain in this market still to come.
It absolutely could.
Nathan, it's good to see you. Thank you, sir. Nathan Sheets there of Citi. Here's a take from a man who's seen it all, the former Deputy Treasury Secretary Adewale Adeyemo, writing, "The only way we can address the China problem is by working with other countries. But for many of them, they're still waiting to hear what the US even wants." Wally joins us now for more. Wally, good morning, sir. It's good to see you.
Good to see you here. Thanks for coming to Washington, D.C.
You've been in the room with the Chinese many times. How difficult is it to negotiate with them? Just set the scene. What is it like?
The reality for the Chinese is they are very systematic in trying to find your weaknesses by both talking to you directly, but also talking around you to other people. So when you are negotiating with the Chinese, you have to be very clear about what you want. You have to repeat it over and over. You need to tell your friends and your allies in the hopes that you'll get 50% of what you want in that conversation. And it's always about how do you make progress rather than perfection with the Chinese.
You referred to the China problem. What is the problem? And what do you make of the approach so far?
The reality is, and over the course of this week, in addition to getting to see you, I've gotten to see a number of my former counterparts. And the thing you've heard from our closest allies is just disappointment, because they all face the same challenge, which is that China takes steps to subsidize their industries and export excess capacity to the world. And the challenge we have in the United States is the same challenge they have in Europe, is the same challenge they have in parts of Southeast Asia. And for many of them, they want to work with us to address this, because if the U.S. blocks Chinese goods from coming to America, the people today who are afraid those goods are going to show up on their shores are in Southeast Asia and in Europe, and they now need to think through what are they going to do to deal with China's excess capacity that's coming in their direction.
Let's look at Europe. Are they speaking with one voice? We had the Spanish finance minister in the room here yesterday, and John picked up on something he said. He called China an ally, and we have seen the Prime Minister, Pedro Sanchez, go to Beijing 3 times in the past 2 years. It feels like they're placating to China and actually not coming on board with the United States.
So I think you're right. That's part of the challenge, is that Europe doesn't speak with one voice, because today, if Europe did speak with one voice, they'd be in a better position to negotiate terms. Europe is the third largest economy in the world. If they were willing to work together to do things like put in place the free trade agreement they have with countries like with other countries, and to go and work with the TPP countries, they'd have the ability to dictate more terms. But today, because they're unwilling to, they're caught between China and the U.S., and that's the most important thing for the Chinese. They're concerned that if they don't find a way to dial back this, they're going to end up in a place where countries like Europe or regions like Europe or other countries will choose the U.S. over them. But unfortunately, the approach the Trump administration has taken has, instead of bringing Europe closer to us, put them in a place where they're up for debate. And you hear things like that from the Spanish in terms of, are we allies with the U.S.? Are we allies with China?
And then Rachel Reeves in the UK and along the sidelines of the IMF is saying things like, Trump is right. China does need to rebalance their economy. How difficult was it for you and Treasury Secretary Janet Yellen to get that message across to China? You have to start rebalancing your economy.
And this is not a new message. Secretary Paulson sent it to the Chinese, Secretary Geithner, Secretary Liu, Secretary Yellen, and I know that the current secretary is sending it as well. The truth is that China is only going to respond if they feel pressure, and it's not just going to be from the United States. They've got to feel it from the UK, they have to feel it from Europe, and the best way to do that is to work together to confront the Chinese. Today, the Chinese feel empowered because instead of being confronted by the world who's suffering from their excess capacity, the United States in lots of ways has alienated the world. The hope over the next few weeks is that Secretary Bessent and the President are going to be able to work with our allies and partners to find an approach that works, because the people who are going to suffer most from this are American consumers. You could see their bills go up by $3,000, and that's not just the statistics. You heard all of the CEOs who've been doing earning calls who have said that they're going to have to raise prices. And they've all said that they had great first quarters because the economy is doing quite well. So we're in a place right now where if the United States doesn't get into a posture of working with our allies and partners and reducing these tariff rates, I can't guarantee that we're going to have a recession, but I can say that prices are going to go up for American consumers.
Is it too late to really create that alliance and go after China? Has China already made inroads in terms of making alliances, whether it's with the Spains of the world or even in Southeast Asia?
So the interesting thing I've heard over the course of the last few days here is that people are equally as nervous of American tariffs as they are of Chinese excess capacity. So the people who live in Southeast Asia, the people in Europe, are worried that all those goods that were headed to the United States that were hurting our industrial base are heading to a port near you, and that China's excess capacity is going to overwhelm them. So I don't think it's too late, but our allies and partners are going to be more cautious about dealing with us. But the reason that countries are coming to the United States is because they want to make sure that their industries and their countries aren't overwhelmed by Chinese overcapacity either. So there is an opportunity here, but it's not one that's going to be open forever. And the Chinese are working hard to try and counter that. President Xi's visit was all about trying to buttress their ability to have allies and partners as the U.S. confronts them. But Vietnam, in addition to gaining a great deal of economic value from their relationship with China, has to be worried about Chinese excess capacity showing up there as well.
There was a story in the Financial Times and on Bloomberg about how Apple was moving all of its iPhone production away from China into India. Hopefully by the end of next year, this hopefully for them, that is the projection they put out there. Is that how this is going to work from what you hear, that essentially India is going to be the big beneficiary from a lot of the tariffs, particularly on China?
That's how it's worked the entire time. Since basically the Obama administration, a number of companies have been moving to a China plus one strategy where they build for China in China and they build for everybody else somewhere else. That's been Vietnam, Malaysia, India. But the problem has been Chinese companies have taken a China plus one strategy too. They've moved away from the tariffs they put in China by setting up shops in Vietnam, Malaysia, and probably now in India too. That's why we have to work with these countries, because the Chinese are being very clever about this. They see the huge tariffs that are being placed on them in China, so they're setting up shop. And my understanding is that a big part of the negotiations with Mexico and Canada is around making sure that Chinese firms can't set up plants in Mexico. Ultimately, I think that they should be able to get to a deal with Mexico and Canada because we're such an integrated economy, but it's going to be harder to get to those kind of deals with countries that are closer to China.
Wally, I've got 30 seconds left. Is there anything you wish you'd done differently with regards to this topic?
I think the reality is that the thing you always hope that you could do is get to a deal with your allies and partners to confront the Chinese. But the other thing that I think is clear is that tariffs work when you use them strategically. They don't work when you use them in a broad-based way, because what that does is it causes more pain for your consumers and your allies. And the thing that's worried me a great deal is talking to asset allocators around the world. And for each one of them, they've been overweight the United States for a long time because of the exceptionalism of our economy. But today, each one is talking about reallocating their assets. Hard to find other places to do that in the short term, but if over the long term we don't provide clarity and certainty, the things the American economy has done over the last decades, I do worry about our ability to attract capital into the United States.
Wally, it's good to see you, sir.
Great to see you.
Thanks for being with us. Lots to talk about, particularly the deficit. I've got to talk about that with Wally at another time. The former Deputy Treasury Secretary, Wally Adeyemo. We begin this hour with this week's rally on hold as China downplays progress in trade negotiations. Jason Thomas of Carlyle writing, if Treasury yields do not decline when stocks sell off, investors may discover they've been paying for a hedge that no longer works. Jason joins us now for more. Jason, good morning. Good to see you.
Good to see you. Thanks for having me.
I'm pleased you've picked up on that piece because I want to pick up on it with you as well. This EM-type dynamic that started to take hold of US assets, dollar-denominated assets, what's behind it, one, and do you think it's sustainable, two?
Well, I think, first of all, we have to remember that bonds are volatile in a way that cash is not. So at the start of this month, if you had $100 invested in money markets, it was yielding 4.3%. The 10-year Treasury at the time, 4%. A week later, the cash was still at par, as it always is. The bond was down to 96. And so in the past, there's generally been, of course, a term premium to compensate for the volatility. That went away in the decade after the GFC. Why? Because anytime there was a hint of weakness in the economy, anytime there was a decline in stocks, the Fed would launch another round of QE. With, of course, the intention of driving down bond yields. So, of course, there were many risk parity strategies. You had investors who were hedging their stock market risk through leveraged positions in bonds. That worked very well. Some years, stocks down 12%, those leveraged bond positions up 15%. Now, I think we're in a somewhat different world. Partly, of course, that's the external sector wondering about being over-allocated to the U.S. That's stocks, that's bonds, I think more broadly. The deficit, when you think about how large the deficit is, this year, Treasury net issuance is consuming over 42% of U.S. private savings. That is the savings of the household sector, the free cash flow of the corporate sector. So, if this is not going to be financed in large part by external investors, you have to wonder what the market clearing interest rate is going to be. So I think that what we're seeing is that if there is not this hedge, if treasuries do not predictably rise when stocks fall, then there has to be a much larger risk premium on bonds relative to cash. And if you look historically at the 1980s, 1990s, that was in the range of about 150 basis points.
So it feels like that process is underway. We're working our way through it. Without doubt, you can see it on the screen in the price action of the last several weeks. I want to understand from your perspective how investors should now manage that risk. They've got very used to having this ballast in the portfolio that treasuries typically provide. Where do you go now?
Well, of course, I would recommend that people go to private assets, particularly private credit. But I think that the general portfolio thoughts have to be reexamined. There's talks, of a 50, 30, 20 portfolio. But in general, it's that what has worked, what worked so well in that decade after the GFC is not going to work today. So whatever your solution is, there needs to be a rethink. And I think that, again, it's been so ingrained that treasuries are supposed to rise in value when stocks fall. There's no mathematical law that's supposed to occur. And again, the return correlation with stocks and bonds was positive in the 1980s and 1990s. So this is not entirely new.
Yeah, there is a larger consequence here, though. I'm thinking through as you're saying this, and if you're talking about a clearing price that's different for treasuries to account for that additional risk premium, we could be talking about 5.5% on 10-year treasuries pretty easily based on your calculations, which would have a massive effect on private asset valuations, which would have a massive effect on stock valuations, which just kind of really speaks to this question of whether it's a sell America trade.
Well, I think that, again, if I were thinking about exposure today, it would be short duration. I see a lot of duration risk in the market. And I think generally investors have not had to worry about duration risk. It's again, the mindset is whenever we get into trouble, there's going to be another round of QE, and they're going to drive down longer-term yields. Now we're in a situation where those prices could move in the opposite direction, and that actually compounds losses. I think that the issue right now also, the Treasury is funding 22% of the outstanding stock of debt in the bill market, in the money market. There's of course a desire to term that out, but there's of course a hesitancy. We want to wait for the right time. I think people were hoping that the 10-year would fall below 4%. Then let's term out some of that debt. And by waiting, they might be in a situation where they have to term it out at much higher yields. So it's certainly a concern. And I think, as was mentioned earlier, if you do have a downturn, if you have a decline in tax receipts, if you have an increase in transfer payments, just the scale of debt issuance, and now go from 40% to 50 or 60% of private savings being consumed. So again, I think it's taking the short-term assets. Sometimes the credit spread on that is less risky than the duration spread of holding longer dated assets.
Has this dynamic removed a lot of the power from the Federal Reserve to really address downturns? And I say this at a time where potentially if they drop rates right now, that will only lead to a furthering of this trend of yields in the long end going up.
It's a great point, but we have to remember the Fed is an extremely dovish institution. I mean, and of course they say that's because of the dual mandate. But I mean, think about 1998. The U.S. economy in real terms growing at 4%. Employment to population ratios at all-time highs. the enthusiasm of the stock market. This is 2 years removed from Alan Greenspan's irrational exuberance speech. And they cut rates by 75 basis points because the hedge fund failed. When you think about 2020, the way they did the autopsy of the last 10 years and the statement for policy goals going forward, they said the big mistake in the decade of record monetary accommodation was hiking too fast in 2015. So the Fed is going to cut this year. I mean, it's funny that this is like controversial or, oh, the Fed's in a box. The Fed is going to cut and likely by September.
But how much has the pandemic actually hit them hard in terms of wanting to make that mistake again? Governor Waller said that to Mike McKee, that idea of being transient. He's even nervous to say that word out loud.
I think that this is what Chair Powell has made clear is they can't do preemptive cuts. They have to wait. They have to see.
Didn't they preemptively cut before the election?
Well, I think there was certainly a strong case for rate cuts in September. Now, whether they needed to cut by 100 basis points in just over 3 months, again, this is sort of the dovish nature of the institution coming to the fore. But I think that this is a situation where if you are cutting as tariffs are first taking effect in terms of the increase in the price level, you could accommodate a spiral. So they have to wait. But we're talking about waiting a couple of months. This isn't really, an elongated pause or anything of that sort.
You've said a lot of things that require some real deep thought. There's one thing that scares me. Typically in an economic downturn, bonds rally. And that allows a government to act counter-cyclically. A developed market government, EM, of course, face a very different dynamic. Are you saying that if we go into a downturn, the long end doesn't rally?
I think that the rally is going to be muted. And so, again, if we think, I think the Fed will be more cautious this time, of course. But imagine that we have base rates in the 365 range. Well, these yields actually might be appropriate given the risk premium, the term premium that is required. Maybe you get down to something closer to 4%. But again, I think the important thing as investors think about the next 5 years is that if bonds do not rally in this scenario, that on a prospective basis, when the economy recovers, that they're going to need to target much higher yields, that compensation for the bond price volatility that doesn't exist in cash.
Jason, this is an important exercise, and I'm pleased you dropped by this morning.
Thanks so much for having me.
Thanks for being here. Jason Thomas there of Carlyle. Nasdaq hoping to provide stability in this volatile environment, and the Nasdaq CEO, Adena Friedman, joins us now for more. Adena, good morning. Good to see you.
It's great to see you. Great to be here.
Can you describe the last month for us, if you can? Just how busy have things been? Describe the volume, the activity going through your business.
Well, thanks for having me. First of all, we just announced earnings yesterday, so I think that shows a little bit of what we've been working with. We had 12.5% revenue growth. We had double-digit growth in each of our 3 divisions, and a couple of highlights. One is within our Capital Access Platforms division, our index business grew 26% in the first quarter because of inflows, and we had $27 billion of inflows in the quarter. Very strong futures volumes as well in our Nasdaq 100 franchise. And then we look at our fintech division, that grew 10%, and one of the highlights there is our anti-financial crime business grew 21%, and that's an important key grower for us. And then within our market services division, which is our trading business, that grew 19% in the first quarter because of record volumes in the first quarter, and we continue to see those volumes persist and actually grow into April. The first 10 days of April, we had 5 of the top 6 trading days ever in U.S. equities, 4 of the top 6 trading days ever in options. And in one of the days, we also measured message traffic because that's how many messages our system's handling during a given day. On the peak day, which was April 7th, we had 550 billion messages flow through our systems on that single day. So it has been an incredible period of time from a trading perspective. And the one thing to note, because we talked about this earlier, you don't get necessarily credit for this, but the fact is that the plumbing within the markets, all of the markets, has done really, really well. Hyper resilient. I think we've all been able to manage this volume extraordinarily well. We're very proud of that at NASDAQ, and I can tell you that our markets have done quite well in this period of heightened volatility.
We don't thank you when it goes right, but we'd be very quick to criticize you when it goes wrong, that's for sure. You've handled a lot of volume, volatility good. When does volatility become bad?
Well, I think the one thing to recognize is volatility, and short-term volatility that then can resolve itself. I think that's something that we've seen, frankly, multiple times over the last 5 years. I think the concern is, of course, is if we cannot have some certainty in the markets. Investors like certainty, and right now it's a very uncertain environment. So they tend to take a risk-off attitude about that. And as we know, we are hoping to see more companies go public this year. We did have 45 IPOs in the first quarter, raising $5 billion. One little side fact also is we had 7 companies switch from New York to Nasdaq in the first quarter, and we crossed $3 trillion threshold of companies that have switched to Nasdaq since we started our switch program 20 years ago. But I also would say, though, we have a lot of companies that are looking to go public this year, and and right now, of course, investors are not really in a mode of underwriting a lot of risk, so we're seeing them take a wait-and-see attitude in terms of how to tap the public markets and when to tap the public markets this year.
That was a very subtle but well-placed shot over at the New York Stock Exchange. I'm sure that they will be listening. I am curious about what that pipeline looks like now and how much smaller it is now in terms of IPOs than it was earlier in the year. There's this big question, how much of deals been sort of put on hold and how much have they just been scrapped altogether? Do you have a sense of that?
I think there are more being put on hold. I mean, we have not seen companies suddenly decide they're not going to go public. It's really a matter of they've gotten themselves ready. They've gotten approval, all the approvals they need. It's really now a matter of just having a wait-and-see attitude. And they should be, in terms of thinking about how can they maximize value for their shareholders, how can they make sure that they're entering the markets in an environment that's welcoming. And that could be, you could find windows and pockets of time throughout the year to be able to do that. And we did, as I said, still have 45 IPOs in the first quarter. So it wasn't like the markets are shut. It's just a matter of finding those windows of opportunity within a more volatile environment.
Do you see companies trying to decide or having a harder time deciding whether to IPO in New York or in the United States, in the deepest markets of the world, versus somewhere else, based on the turmoil that we've seen?
Well, we are really the home to global companies as well as American companies. The conversations continue to be very constructive, robust. They're very interested in coming and tapping the American investor and frankly the global investor base. I mean, in the United States, we are the most liquid markets in the world. We have the most variety of investors. We have the deepest pools of liquidity. I think those things are constant attractions in terms of companies who want to go public. Again, it's really more a matter of timing than it's more a matter of when than if they want to come and tap the public markets here in the United States.
I was here during Trump's inauguration while you were speaking to John and Lisa over in Davos, and you were very constructive on the incoming administration when it came to the excitement around IPOs, also deregulation. You were pushing for this regulation overhaul. Are you seeing what you were expecting back in Davos from this administration now in their first 100 days?
From a regulatory perspective, we are very excited about the fact that we can work constructively with the regulators that are coming into with the positions. With Chair Atkins coming into the SEC, he has deep understanding of the markets. He has a deep understanding of U.S. capital markets and also the need for companies to have a good public company experience and how important that is in terms of giving citizens access to the growth of our economy. So we are looking forward to engaging with him. We just put out a white paper on the need for reform in the regulatory landscape for public companies to have to be able to have a life as a public company and not have it be a oh gosh moment, but more a I can't wait moment. And so I think that that's something that we're really looking forward to engaging Chair Atkins on.
How big is the tone shift from the Biden administration and Gary Gensler to Chair Atkins?
Well, he just came into office, so we are going to introduce ourselves to him. We actually do know him from when he was a commissioner many years ago, but reintroduce ourselves to him, and we'll look forward to engaging with him as he gets going in his new seat.
You've been through a lot of different market regimes. How would you describe this one? How unique is it?
Well, it's funny. I have actually been part of many market events. I've been at Nasdaq, started at Nasdaq 32 years ago, so I've seen a lot. And every single one of them is different. I have to say, there's no two situations where you see a lot of volatility that are exactly the same in terms of the causes of volatility. What we've seen in terms of the reactions from investors is pretty consistent. When the thing, as I mentioned before, is that the thing that they like the least is uncertainty. And in any period of time where you suddenly have a big moment of uncertainty, uncertainty, they take the same attitude, which is a risk-off attitude. I'm going to take some of my positions out of the market. I'm going to sit and wait and understand what's happening, and then I'm going to re-engage in a smart way. That's a very consistent reaction. But the causes of every single period of market volatility have been different, actually, over the last 32 years.
Certainly feels unique this moment, that's for sure. Adena, thanks for dropping by. Appreciate your time. Thanks for being with us. Adena Friedman there, the Chair and CEO of Nasdaq.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.